Welcome back. In this video, we'll continue our discussion of fiscal policy and monetary policy and go in a little bit more depth before we have videos that are dedicated to fiscal policy and monetary policy specifically. So with fiscal policy, it's really going to affect aggregate demand in three different ways. One is on spending on goods and services, right? So that's our G in our C plus I plus G plus X minus IM. And so if the government spends more, that's going to increase aggregate demand. If the government spends less, that's going to decrease aggregate demand. Now, just keep in mind that this type of spending is actually mostly done at the state and local level in the United States, whereas the federal government's spending on goods and services is mostly done for the military. Government investment is more spread out between federal, state, and local governments, building things like roads, electrical grids, all the things that we use in order to be more productive. And then finally, taxes and transfer payments. And so these will affect aggregate demand indirectly by affecting disposable income. So higher taxes will decrease disposable income, higher transfer payments will increase disposable income, and therefore impact consumer spending C. Now, monetary policy is really all about trying to control inflation and using interest rates in order to do that. And so most central banks these days have an inflation target. Usually it's around 2%, sometimes 2.5%. Some economists have argued that it should be maybe 3 or 4%, but I think what we've seen in the last few years is how much people dislike inflation, so perhaps 2% makes sense. In normal times, the Federal Reserve or any central bank will have a policy interest rate. In the United States, it's called the federal funds rate. And we'll often just call it the policy rate just to be more general. And changes in that interest rate will then impact other interest rates throughout the economy. So mortgage interest rates, business interest rates, auto loan interest rates, and that will impact how much housing we build, how much business investment there is, how much people buy, consumer durables like refrigerators and washers and dryers, as well as impacting how much people save, because that will also be impacted by the interest rate. So we will talk a little bit later when we get more into monetary policy and banking about that this is not exactly how monetary policy works in the United States right now. And so they have a couple different interest rates that they target. So one thing just that we should know in the United States is that our central bank is called the Federal Reserve System. We didn't have a central bank until 1913, at least not a real central bank. There were a couple United States banks throughout our history, but they didn't really act like a modern central bank. We've always had sort of a distrust of banking in this country. And so the way they created the Federal Reserve System was to have 12 regional banks spread out throughout the country with a board of governors in Washington, D.C. And so the Federal Open Market Committee, which is the group of people at the Fed that control monetary policy, is made up of the Board of Governors as well as sort of a rotating number of the regional bank presidents. And it targets the federal funds rate. So in normal times, the federal funds rate is that sort of bank basic policy rate, and it's the rate at which banks lend reserves to each other. Now, that's not going to make too much sense yet because we haven't done the whole sort of banking system. But when we do, we'll talk more about monetary policy. Now, Congress has told the Federal Reserve, listen, you have two jobs. One job is full employment and one job is stable prices. Now, we know from our models that full employment where, there's no unemployment is not feasible, at least not directly feasible. And stable prices where there's 0% inflation is probably not desirable because then sometimes we would have deflation, which is probably more costly than somewhat higher inflation. So generally, the Federal Reserve targets what they estimate to be the natural rate of unemployment, or that structural unemployment rate, and a 2% inflation target. Now, one of the things that we need to understand about interest rates is that most of the time that we see them, they are nominal interest rates. And nominal interest rates mean that, you borrow dollars and you pay back dollars. That makes sense, right? But what we usually really care about is real interest rates. And so a real interest rate is, all right, well, how much stuff are you going to be able to buy with that real interest rate? And so the general sort of shortcut equation is known as the Fisher equation. And really what it just says is that the real interest rate, R, is equal to the nominal interest rate, I, minus expected inflation. Now we'll get a little bit more into that, but basically this just means that when inflation is higher, right, then the real interest rate tends to be lower. But it also means that when we have deflation, right, and we'll talk about this at the end of the semester when we talk about the Great Depression, then that minus expected inflation is minus a negative number, and so that becomes positive, and the real interest rate is higher, and that can be a problem in terms of getting to the right interest rate to get the economy back into balance. So let's go back to our aggregate demand model, our Keynesian cross model, and think about what happens when we have a negative demand shock, right? And so our aggregate demand curve shifts down, so we move from A to B, right? We know that the multiplier says that the change in GDP will actually be larger than that initial change. So in this case, we have lower investment. So, that might be a good fit for the financial crisis in 2008, where we stopped building so many houses. The COVID pandemic in 2020 was caused partly by decreased investment, but also by a big decrease in consumer spending. And so that was a big shift down. Now, we were at A. That was our supply side equilibrium. We get down to B, right, which is a lower GDP. That means higher unemployment rate. And we want to get back to A, right? So that's the goal of the policy, is to push the economy back to A. Now, in this case, obviously, what we want to do is to increase aggregate demand. And so we can do that either through lowering interest rates, right? That would be the monetary policy solution. And so we try to lower interest rates in order to increase investment, whether that is residential investment, building new houses, or business investment. Either way, that would hopefully push us back to A. The other option, of course, is to increase aggregate demand by either increasing government spending or decreasing taxes. And so both of those should also shift up aggregate demand and move us back towards A. Either way, the goal is to get us to that supply side equilibrium, right? That equilibrium where there's no bargaining gaps, and so there's no pressure on prices to either increase or decrease. Monetary policy is usually faster. They meet every 6 weeks. They go over lots and lots of economic data all the time. And, if they try to keep that inflation target at 2%, so that expected inflation is 2%, and then if they know that actual inflation is 2% as well, then that should mean there's zero bargaining gap, and so we should be at that supply side equilibrium. But sometimes we do need fiscal policy, and we'll talk more about fiscal policy in the next video. But there are some types of fiscal policy that sort of kick in automatically that really help smooth out the business cycle. Things like unemployment benefits, right? So that when you lose your job because of a downturn in the economy, you still have some income to pay your bills. Now, we saw, in our last graph that both the monetary policy and fiscal policy are designed to change aggregate demand. And that can be a problem if we get some supply side shock, right? If we get that increase in the price of oil, or a change in bargaining power or the markup. And so if we get an inflationary supply shock, it's not clear what, for instance, monetary policy should do, right? Because now we're going to have higher prices and higher unemployment. Should we try to push output down in order to bring inflation back towards target, or should we try to increase aggregate demand to bring the unemployment rate down, but that might just increase inflation? And so this is an issue with both fiscal and monetary policy, is that they can respond fairly well to demand shocks, but don't have as powerful tools to respond to supply side shocks. Now, there are other possibilities, right? So we'll talk more when we talk about international sort of finance and economics about common currency areas. So the United States, for instance, is a common currency area, but so is the Eurozone in Europe. And in those countries, you only have one monetary policy. So in the United States, that's okay because we have common fiscal policy. We have, you can move wherever you want in the country. So if one area doesn't have a lot of jobs, you can move to an area that does have a lot of jobs. In Europe, it's a little bit more difficult because they don't have exactly common fiscal policy, right? So they do have some ways to try to smooth out fiscal spending between the countries. But movement is somewhat limited. Even though you're allowed to move from Spain to Germany, you might not want to because you might not speak the language, and so that can be a problem. And then there are some countries that will fix or target their currency to another currency, and in those countries, again, you lose your monetary policy. And so we'll talk about that more when we talk about exchange rates and international economics a little bit later in the semester. So if we want to think about what happens with a negative supply shock, right? So, for instance, we get that oil price shock, right? That's sort of the common example in economics textbooks, I think probably because most people writing textbooks were brought up, did their PhD in the 70s when this was actually happening. But so then we move from A to B, and at that point we have a positive bargaining gap. And so now if we stay at that level, right, of employment, we're just going to get higher and higher inflation. And so eventually we're going to need to move to that new supply side equilibrium. And frankly, we probably want to do it sooner rather than later, right? Because if we do it immediately, then okay, we have zero inflation, which is not what we want. If we allow the Phillips curve to shift up, to that middle rung, and then we move to our new supply side equilibrium, then we are at our inflation target of 2%, but we have, of course, higher unemployment and lower output. And there's not much that monetary policy can do about that. We would need other policies that are designed to increase productivity, increase, human capital or physical capital or better technology. But the danger is that, if we wait too long, then our Phillips curve shifts up even higher. And then when we move to our new supply side equilibrium, we're at a higher inflation rate than we want. So what do we do? Well, the goal really is that the monetary policy tries to keep us at that targeted inflation. And so if they see inflation going up, then they raise interest rates. And in this case, we would go, to C because of those higher interest rates. As we said, there's not a whole lot that the central bank can do about this because of the negative supply shock. But that doesn't mean that it will be popular, right? Because now the unemployment rate is higher, and there could be some pressure in order to keep interest rates lower. But we know that if they do that, then the Phillips curve shifts up, and we end up with higher inflation, which also will not be very popular. Now, one question, of course, is whether or not this is sort of a permanent shock or a temporary shock. If it's just a temporary shock, then we might just, move from A, to B and then back to A. But if it's a permanent shock, then we're going to end up at C, hopefully not with too high inflation. And so that's the key, right? Is this, if the central bank delays and inflation keeps creeping up, then inflationary expectations will increase. And we saw in chapter 4 that you really don't want higher expected inflation to become embedded in the economy, right? Now it just keeps shifting up and up and up. And that's really what we saw in the 60s and 70s, as opposed to what we just had, right, in 2022, 2023, is we did get this spike in inflation, but we did not get a big increase in inflationary expectations. And that allowed inflation to come back more quickly without a big increase in the unemployment rate. All right, so we're going to stop this video here, and in the next video, we'll go into more detail on fiscal policy specifically, and then the last 2 videos for this chapter will look at monetary policy in more depth.